Disclaimer.
Economics explained simply, factually, and without the fluff. Subscribe and like. Pop quiz. What costs $72 in New York but $78 in Shanghai at the exact same moment? The answer should be nothing. That's how global markets work. Prices converge. Arbitrage traders make sure of it. Except right now, with silver, something fundamental has broken. And in 72 hours, the situation gets dramatically worse. December 24th, 2025. While most Americans were wrapping presents, traders in Shanghai were paying $6 to $8 more per ounce for physical silver than the paper price listed on our COMEX futures exchange in New York. Think about that for a second. We're not talking about a few pennies of difference or temporary market friction. We're talking about an 8 to 10% premium for the exact same metal sustained for weeks, widening by the day. Here's what should grab our attention. This isn't supposed to be possible in modern markets. When gold trades in London, New York, and Shanghai, the prices align within dollars, sometimes within cents, because the moment a meaningful gap opens, someone borrows money, buys the cheap version, sells the expensive version, and pockets the difference. That arbitrage mechanism has kept commodity markets honest for centuries, but with silver right now, that mechanism has completely failed. You know what's even stranger? The failure isn't random, it's directional. Shanghai consistently trades higher. Physical metal commands a premium over paper contracts. And the gap isn't closing, it's accelerating. According to data from the Shanghai Futures Exchange, this premium hit its highest levels in December 2025, just as something massive was about to change the silver market forever. Let me put this in perspective with a scenario you can relate to. Imagine you're planning to buy a used car. The dealer in your town wants $30,000. You check online and find the identical model, same mileage, same condition, listed for $27,000 one state over. What do? You drive to the other state, buy the cheaper car, maybe even flip it for profit back home. That's arbitrage. It's not complicated. It's how markets stay balanced. Now imagine the cheaper car is in New York and the expensive one is in Shanghai. But here's the catch. You can't actually drive the car from New York to Shanghai anymore. The shipping routes are closing. The bridges are out. And in 72 hours, the border between the two markets slams shut completely. Suddenly, that price gap isn't an opportunity anymore. It's a warning sign that two separate markets are about to exist for the same commodity. That's exactly what's happening with silver. The deadline is January 1st, 2026. In 3 days, China implements export restrictions, requiring an 80-ton minimum refining capacity and government licenses to export silver. According to analysis from the World Gold Council, this instantly cuts 60 to 70% of global refined silver supply from reaching Western markets. Not gradually, not over time. On January 1st, the silver that's been flowing from Chinese refineries to London vaults and New York exchanges just stops. Think about our country's relationship with Chinese manufacturing for a moment. We've spent 2 decades outsourcing production, watching factories close in Pennsylvania and Ohio while supply chains stretched across the Pacific. We told ourselves global markets meant infinite supply at competitive prices. And for most goods, that worked, until nations started using supply as strategy instead of just economics. We saw it with rare earth minerals when China controlled 97% of global production and suddenly restricted exports in 2010, sending prices through the roof. We're watching it play out with semiconductors right now, and we're about to see it with silver. But here's where it gets really interesting. The export restrictions aren't hitting an abundant market. They're hitting a market that's already showing serious cracks. In early December 2025, something unprecedented happened at the COMEX exchange in New York, the primary hub where silver trades in North America. Over just 4 trading days, 60% of registered inventory was claimed for physical delivery. We're talking about 47.6 million ounces demanded for actual metal, not paper settlement. Let me explain why that matters. When you or I think about commodities trading, we picture physical stuff changing hands, but that's not how modern exchanges primarily work. Most silver trades on COMEX are paper contracts, promises to deliver metal at some future date. The actual physical silver sitting in exchange vaults, that's just a small fraction backing the total claims. It's like fractional reserve banking, but for metal. The system works beautifully as long as most traders settle in cash rather than demanding physical delivery. Except in December 2025, traders stopped playing along. According to exchange data, this was the fastest drain of registered COMEX inventory in the exchange's history. Not the largest in absolute terms, but the fastest, meaning the demand for physical metal hit with sudden, overwhelming force. In 4 trading days, more than half the available silver was claimed and removed from the system. Have you noticed what's been happening in your investment portfolio lately? If you own silver mining stocks or silver ETFs, you've probably seen some volatility. But here's what most financial news isn't clearly explaining. There's a massive difference right now between owning paper claims to silver and owning actual physical silver. The people draining COMEX vaults in December weren't making random trades. They were converting paper into metal before the window closes. Think about this scenario. You have a gift card to a store that is closing in 3 days. The store's been great about honoring those cards, but once the door's shut, you're stuck with a piece of plastic. So what do? You rush to the store and redeem that card for actual merchandise before the deadline. That's what's happening at COMEX right now, except the gift cards are futures contracts. And the merchandise is 47 million ounces of silver that just walked out the door. Now, connect those two pieces. Shanghai trading at a premium to New York, and COMEX vaults draining at record speed. This isn't two separate problems. This is one massive supply crisis showing up in two different ways. The Shanghai premium tells us physical silver is scarce in the world's largest manufacturing economy. The COMEX drain tells us traders are scrambling to secure physical metal before January 1st slams the door on Chinese supply. And both signals are screaming the same message. The paper price is fictional. Here's where it gets personal for Americans trying to protect our wealth. We've been told silver is around $72 an ounce based on COMEX futures. Our financial advisors, our investment apps, our market data, everything shows that number. But if you actually tried to buy significant physical silver right now, you'd discover the real price is whatever Shanghai is paying, plus shipping, plus a premium for immediate delivery. You're not paying $72. You're paying $78, $80, maybe more, depending on the form and quantity you want. What if I told you the COMEX price is becoming irrelevant? That futures exchanges like COMEX have historically set the global price for silver, but that system only works when unlimited supply backs those paper contracts. When supply gets constrained, when the biggest refining nation cuts off exports, suddenly the paper market becomes a sideshow and the physical market sets the real price. We're watching that transition happen in real time, and most Americans have no idea it's occurring. According to data from the Bank for International Settlements, the total notional value of silver derivatives dwarfs the actual available physical supply by factors we'll explore in detail. But here's the key point. In 72 hours, that imbalance becomes impossible to hide. When Chinese silver stops flowing west, when COMEX vaults continue draining, when industrial users panic about securing supply for their production lines, the carefully maintained illusion of abundant silver at stable prices falls apart. You might be wondering, why does this matter to me? I don't trade silver futures. I'm not a commodities investor. Fair enough. But silver isn't just a precious metal for investors. It's in your phone, your car, your solar panels, your medical equipment. It's in every electronics device, every touchscreen, every electric vehicle battery. The industrial demand for silver is enormous and growing, especially as our economy transitions to green energy. When the price of silver spikes, those costs flow through to everything we buy. The people who should be most concerned right now are the ones counting on paper assets to protect them in uncertain times. If you bought a silver ETF thinking you own silver, you might actually own a claim in a long chain of claims, all backed by vaults that are rapidly emptying. If you're holding mining stocks, you're betting those companies can produce silver profitably at current prices. But what happens when the global price resets to Shanghai's physical market instead of New York's paper market? In 3 days, the rules change. The supply that's flooded Western markets for years gets cut off. The arbitrage that used to keep prices aligned becomes impossible. And the traders who've been quietly draining COMEX vaults will have secured their physical metal, while everyone else is left holding contracts that might settle in cash instead of metal. This isn't a prediction about some distant future crisis. This is happening right now on a timeline measured in hours, and the evidence is hiding in plain sight if you know where to look. So, where's the evidence that this supply crisis is real and not just market speculation? Let's rewind to October 2024, when something extraordinary happened that most Americans never heard about. China exported 662 tons of silver in a single month. To put that in perspective, China's normal monthly silver exports run around 300 to 350 tons. In October, they doubled it. They flooded the market with every ounce they could ship before the clock ran out. According to Chinese customs data, this wasn't random market activity. This was small and medium-sized refiners liquidating their entire inventory because they knew exactly what was coming. The new export regulations require an 80-ton minimum refining capacity and government licensing. If you're a smaller refinery that processes 20 or 30 or 50 tons, you don't meet the threshold. You can't get the license. And on January 1st, 2026, your ability to export silver ends forever. Think about what that means from a business perspective. You're running a silver refining operation in China. You've built relationships with miners, you've invested in equipment, you've established supply chains to London and New York. Then the government announces that unless you're one of the giant state-connected refineries, you're out of the export business in 14 months. What do? You sell everything you can while you still have access to global markets. You liquidate inventory, you push through every ounce, and you get paid in dollars or euros before those markets become unreachable. That's exactly what happened in October 2024. 662 tons represented thousands of small refiners saying goodbye to the international silver market. They weren't planning to stop refining silver. China's domestic demand is massive and growing. They were just accepting that from January 2026 forward, every ounce they produce stays inside China to serve Chinese industries, Chinese manufacturers, Chinese demand. Now here's where the story gets even more revealing. While Chinese refiners were flooding exports, Chinese industrial companies were doing the exact opposite. They were buying and hoarding. Shanghai Futures Exchange inventories collapsed to 10-year lows in November 2025 after a 300-ton withdrawal in October. Let that sink in for a moment. China was simultaneously exporting record amounts to the West, while Chinese companies were pulling massive quantities out of domestic exchange warehouses. Why the contradiction? Because Chinese solar manufacturers, electric vehicle producers, and electronics companies understood the new reality before anyone else. Once January 1st arrives, the silver that used to flow freely between China and the rest of the world gets trapped. If you're a Chinese company that needs silver for production, you can't count on imports anymore. You need to secure your supply from domestic sources. And if domestic supply is about to become the only supply, you better stock up now before prices skyrocket. According to industry reports from the China Nonferrous Metals Industry Association, this wasn't panicked buying by small players. This was methodical accumulation by the country's largest industrial manufacturers. These are sophisticated companies with supply chain analysts and strategic planning departments. They ran the math on China's domestic silver production versus domestic industrial demand, and they realized the same thing. Once exports stop, China transitions from a silver exporter to a silver importer, except there won't be enough global supply to import, even if they wanted to. Have you noticed how your electronics have gotten more expensive lately? How solar panel installations cost more than quotes from a year ago? Part of that is general inflation, sure. But part of that is forward-thinking manufacturers already pricing in the silver supply crisis they see coming. They're locking in physical metal now and passing those costs through to consumers before the real shortage hits. Let me give you a concrete example of how this plays out. Imagine you manufacture solar panels in California. Each panel requires about 20 grams of silver for the electrical contacts. You've been buying silver at relatively stable prices for years, sometimes from Chinese refiners, sometimes from Mexican mines, sometimes from recycled sources. Suddenly, in late 2024, your Chinese suppliers tell you they can't fulfill orders after January 2026. Your other suppliers are getting overwhelmed with new demand from companies in your exact situation. What do? You start buying physical silver immediately. You build inventory. You secure supply contracts at higher prices. You do whatever it takes to ensure your production lines don't shut down because you can't source a critical raw material. And when dozens of solar manufacturers and hundreds of electronics companies and thousands of industrial users all make that same decision simultaneously, you get the exact market dynamics we're seeing right now. But the most dramatic evidence that something unprecedented is happening does not come from export data or inventory levels. It comes from the structure of the silver market itself. In October 2024, silver went into backwardation in Shanghai. If you're not familiar with that term, let me explain why it's such a massive red flag. In normal commodity markets, future delivery costs more than immediate delivery. That makes intuitive sense, right? If I promise to deliver you silver in 6 months, I need to store it, insure it, finance it for those 6 months. So the 6-month price should be slightly higher than today's spot price. That normal state is called contango. When the opposite happens, when immediate delivery costs more than future delivery, that's backwardation, and it signals severe physical shortage. Think about it this way. If spot silver costs more than silver for delivery in 6 months, the market is telling you that people are so desperate for metal right now that they'll pay a premium to get it immediately, even though logic says waiting should be cheaper. That desperation pricing only happens when users genuinely fear they won't be able to get metal at any price if they wait. Shanghai silver went into backwardation in October 2024. According to Shanghai Futures Exchange data, spot prices traded above 3-month and 6-month futures for weeks. At the same time, silver lease rates, the cost to borrow physical silver, spiked above 30%. To put that in perspective, normal silver lease rates run 1 to 3%. 30% lease rates mean someone was so desperate to access physical silver that they'd pay 30% annualized interest just to borrow it temporarily. You know who noticed? Elon Musk. On December 27th, 2024, he posted on social media, "This is not good. Silver is needed in many industrial processes." Coming from someone who runs Tesla, which uses silver in every vehicle's electrical system and every solar panel installation, that's not casual commentary. That's someone looking at his supply chain and recognizing a serious problem approaching. What makes Musk's warning particularly significant is the timing. He posted that just days before the January 1st deadline, right as COMEX vaults were draining and Shanghai premiums were widening. He wasn't reacting to media hype or speculative trading. He was reacting to actual supply constraints affecting his manufacturing operations. When the world's most prominent industrialist, who depends on silver supply, publicly says, "This is not good," maybe the rest of us should pay attention. Here's what should terrify anyone holding paper silver claims: the October front-loading, the Shanghai inventory collapse, the backwardation, the lease rate spike. These are all symptoms of the same underlying disease. There isn't enough physical silver to meet demand even before Chinese exports stop. Once those exports end in 3 days, the supply deficit goes from serious to catastrophic. According to estimates from the Silver Institute, China's export restrictions will remove 2,400 to 2,500 tons of refined silver from global markets annually. That's not a one-time shock. That's a permanent structural reduction in available supply. And it's hitting a market that was already running deficits, already seeing inventories drawn down, already showing signs of physical tightness. Let me put those numbers in context you can understand. 2,400 tons equals roughly 77 million ounces. Global silver demand in 2024 was around 1.2 billion ounces, with supply around 1.1 billion ounces. Already a deficit of 100 million ounces. Now remove another 77 million ounces of supply. You've got a deficit of nearly 200 million ounces annually. And that's before accounting for growing industrial demand from solar, electric vehicles, and 5G infrastructure. What happens when demand exceeds supply by 200 million ounces every year? Either price rises dramatically to destroy demand, meaning industrial users cut back because silver becomes too expensive, or users bid up physical metal to whatever price is necessary to secure supply, regardless of what paper contracts say the price should be. Given how essential silver is to modern technology and how difficult it is to substitute, we're likely to see the second scenario play out. You might be thinking, okay, but can't mines just produce more silver to fill the gap? Great question, and the answer reveals another layer of this crisis. Silver isn't usually mined as a primary product. About 70% of silver production comes as a byproduct of mining other metals: copper, lead, zinc, gold. You can't just tell a copper mine to produce more silver. The silver comes along with the copper at whatever ratio the ore deposit contains. According to data from the Silver Institute, bringing new silver production online takes 5 to 10 years, from discovery to full operation. You need to find deposits, secure permits, build mines, construct processing facilities. Even if miners started today in response to higher prices, we wouldn't see meaningful new supply until the early 2030s. In the meantime, the deficit compounds year after year, inventories drain, and the gap between available physical metal and outstanding paper claims grows wider. The front-loading we saw in October 2024 was the last gasp of the old system where Chinese silver flowed freely to Western markets. That silver is gone now, already absorbed into vaults and industrial stockpiles and investment holdings. The inventories that collapsed in Shanghai aren't coming back. The refiners that liquidated in October can't resume exports even if they wanted to. And in 72 hours, the door closes permanently on the supply source that has been keeping Western silver markets supplied for the past decade. This is what systemic change looks like. Not a sudden crash, but a series of warning signs that most people miss because they're watching price charts instead of physical flows. The people who understood what October's 662 tons meant, who recognized the significance of Shanghai's backwardation, who noticed that lease rates spiking to 30% indicated genuine scarcity, those people acted months ago. They secured physical metal. They moved paper claims into allocated storage. They positioned themselves for what comes next. The question for everyone else is simple. Do you believe the paper price reflects reality? Or do you believe the physical market signals we're seeing across multiple indicators? Because in 3 days, we're all going to find out which one was telling the truth. Let's talk about the numbers that keep exchange executives awake at night. Right now, COMEX has 542 million ounces of open interest. That's the total amount of paper silver claims outstanding on the exchange. These are contracts representing promises to deliver physical silver. Now here's the uncomfortable part. COMEX only has 97 million ounces of registered physical silver actually available for delivery. Do the math. That's a leverage ratio of 5.6 to 1. Think about what that means in practical terms. If you and 5 of your friends all have claim tickets to the same car, everything works fine as long as only one of you actually tries to drive it at any given time. But what happens when all 6 of you show up demanding the keys simultaneously? Someone's walking home. That's the situation facing COMEX right now, except instead of 6 people and 1 car. We're talking about 542 million ounces of claims backed by 97 million ounces of metal. According to exchange rules, COMEX is perfectly allowed to operate this way. It's not fraud in the legal sense, it's how commodity futures exchanges function. The system relies on the assumption that most contracts will settle in cash rather than physical delivery. Historically, that assumption held true. Maybe 5% of contracts demanded physical delivery in any given month. The other 95% just rolled over into new contracts or settled for cash based on the paper price. But December 2025 shattered that assumption. When 60% of registered inventory got claimed in 4 trading days, that wasn't 5% requesting delivery. That was a fundamental shift in trader behavior from paper settlement to physical demand. And if that trend continues, if even 20% of those 542 million ounces demand delivery, COMEX faces a mathematical impossibility. 20% of 542 million is 108 million ounces. The exchange only has 97 million ounces available. The math doesn't work. What happens when an exchange can't deliver physical metal to satisfy contracts? They declare force majeure and settle in cash instead. You thought you bought silver, but you actually just made a bet on the silver price. And when settlement time comes, they hand you dollars based on whatever price the exchange determines is fair. Except here's the problem. If the exchange can't deliver physical metal, how can it credibly claim to set the physical metal price? Let me give you a scenario that illustrates the problem. Imagine you're an industrial user who needs 1 million ounces of silver for your manufacturing process. You bought futures contracts at $72, thinking you locked in your supply. January 1st arrives. Chinese exports stop, physical premiums explode, and suddenly COMEX tells you they're settling your contracts in cash at $72, while physical silver is trading at $90 in the spot market. You just lost $18 per ounce, $18 million total, because you trusted paper markets to reflect physical reality. That's not a hypothetical. That's the scenario facing manufacturers, electronics companies, solar panel producers, and everyone else who hedged their silver needs using COMEX futures. They thought they were securing supply. They were about to discover they were just making price bets in a system that has become disconnected from physical delivery. And when that realization spreads, when industrial users lose trust in paper markets and demand physical settlement, the whole structure collapses. Here's what makes January 1st, 2026 so critical. It's not just about Chinese export restrictions. It's about the permanent reset of global silver flows. According to analysis from metals trading firms, China's new policy removes 2,400 to 2,500 tons from international markets every single year going forward. Not temporarily, not subject to negotiation, permanently locked inside China for domestic industrial use. You know what this reminds me of? China's rare earth strategy from the 2010s. China controlled 97% of global rare earth production. Western countries relied on Chinese exports for everything from smartphones to fighter jets. Then in 2010, China restricted rare earth exports. Prices spiked by 300 to 400% within months. The US suddenly realized we'd outsourced our supply chain for critical materials to a strategic competitor who could turn off the tap whenever it served their interests. We're watching the exact same playbook with silver. China's calling it their dual circulation strategy, prioritizing domestic supply chains over international trade. The government looked at silver demand from their solar industry, their EV sector, their electronics manufacturing, and their infrastructure build-out, then calculated that keeping silver domestic serves Chinese strategic interests better than exporting it for dollars. The 80-ton minimum capacity requirement isn't about quality control. It's about consolidating export authority with large, state-connected refineries that follow government direction. Think about our position as Americans in this new reality. We don't produce enough silver domestically to meet our industrial needs. Mexico's our largest supplier, but Mexican production isn't growing fast enough to offset the loss of Chinese supply. Peru and Australia produce significant amounts, but that silver was already committed to other markets. And recycling, while important, only provides about 15% of annual supply. We've structured our electronics industry, our solar ambitions, our electric vehicle transition around the assumption of abundant silver at stable prices, and that assumption is about to get stress tested. According to estimates from commodity analysts, the supply deficit created by China's restrictions will push global inventories toward critically low levels by late 2026. Remember, we were already running a 100 million ounce annual deficit before Chinese exports stopped. Add another 77 million ounces of missing supply, and we're looking at deficits approaching 200 million ounces per year. At that rate, above-ground inventories drain completely within 3 to 4 years unless something dramatic changes. What are the options for closing that gap? Higher prices that destroy industrial demand, meaning manufacturers use less silver or find substitutes, except substitutes don't exist for most applications. Massive new mine production, except that takes 5 to 10 years to bring online. Increased recycling, helpful, but can't scale fast enough to replace primary supply. Or we enter a multi-year period of severe physical shortage, where price becomes irrelevant because you simply can't source the metal at any price. Wall Street analysts are starting to wake up to this reality. Price targets for silver in 2026 range from $80 on the conservative end to $120 from analysts who understand the supply dynamics. But here's what you need to understand about those projections. They're based on the assumption that markets remain orderly, that COMEX doesn't face a delivery crisis, that industrial users don't panic. If any of those assumptions fail, if we see genuine shortage rather than just tight supply, those price targets become meaningless. Let me paint you a picture of what that looks like. It's March 2026. Chinese silver exports have been cut off for 3 months. COMEX registered inventory is down to 30 million ounces and falling. A major solar manufacturer can't source silver for their production line. They offer $95 per ounce for immediate physical delivery. Other manufacturers, seeing this, start bidding $100 to secure their own supply. The Shanghai premium to COMEX widens to $25 per ounce. At what point does the paper price on COMEX become completely irrelevant to physical market reality? You might think I'm being dramatic, but this already happened to palladium in the late 1990s. Russia controlled most global supply. When Russian exports tightened, palladium went from around $200 per ounce to over $1,000 within 2 years. The shortage was so severe that car manufacturers stockpiled metal and paid massive premiums over spot prices just to keep their catalytic converter production running. Silver's situation is different in some ways, but remarkably similar in others. Concentrated supply, industrial dependency, growing deficits, and a paper market that may not survive contact with physical reality. Here's what should concern every American holding financial assets. The silver market is relatively small compared to other commodities. Total annual production is around 1 billion ounces, worth maybe $70 to $80 billion at current prices. That's tiny compared to oil or copper or gold. When markets that small face severe supply disruption, prices don't rise gradually. They spike violently because there's not enough liquidity to absorb sudden demand shifts. And those price spikes don't just affect silver investors. They flow through to solar panel costs, electronics prices, electric vehicle expenses, and industrial production costs throughout our economy. According to the Silver Institute, industrial demand for silver is projected to grow significantly through the rest of this decade, driven primarily by solar panel production and 5G infrastructure. Solar alone could consume over 300 million ounces annually by 2030, nearly 1/3 of total supply. That's not speculation. That's based on current solar installation targets and existing silver usage per panel. Unless someone invents a substitute technology that works as well as silver at conducting electricity, that demand is coming whether we have supply to meet it or not. Have you looked at your retirement portfolio recently? If you own broad market index funds, you own companies that depend on silver supply. Tech companies need silver for electronics. Auto manufacturers need silver for vehicle electrical systems. Industrial companies need silver for various applications. When silver prices spike, those companies face margin compression and potential production disruptions. The silver shortage is not just a commodity story. It is a systemic risk to industrial companies throughout our economy. Now let's come back to COMEX and that 5.6 to 1 leverage ratio. Exchange officials will tell you this is normal, that futures markets have always operated this way, that they have procedures for handling increased delivery requests. And in normal times, they'd be right. But we're not in normal times. We're 72 hours away from a permanent structural change in global silver supply, facing the fastest vault drain in exchange history, watching paper prices diverge from physical prices by unprecedented amounts. These are not normal market conditions. The people positioning for this shift aren't retail investors responding to social media hype. They're industrial users securing supply, sophisticated traders who understand supply-demand dynamics, mining companies hedging their production, and allocators moving from paper claims to physical holdings. According to trading volume data, large institutional orders have been driving the COMEX vault drain, not small speculators. These are entities with resources to analyze the situation and act before the crowd figures it out. What's the smart move for regular Americans trying to navigate the situation? That depends on your specific circumstances, your risk tolerance, your investment timeline. But here's what's clear. The assumptions that made sense in the old silver market, abundant supply, reliable pricing, interchangeable paper, and physical, no longer hold in the new reality beginning January 1st. You need to understand the difference between owning paper claims and owning physical metal. You need to recognize that Shanghai premiums are showing you the real physical price, while COMEX shows you an increasingly fictional paper price. Think about the broader message here. We're watching a critical industrial commodity transition from abundant supply to structural shortage. We're seeing a major producing nation weaponize export controls for strategic advantage. we're discovering that paper markets can diverge dramatically from physical markets when supply gets constrained. And we're learning these lessons in real time with a 72-hour deadline instead of years to prepare. This isn't just about silver. This is about how global supply chains work, how commodities are priced, how nations use resource control as strategic leverage, and how quickly stable markets can become unstable when fundamental assumptions change. The lessons playing out in silver over the next few months will apply to other commodities, other supply chains, other strategic resources, where we've outsourced production and trusted global markets to deliver abundance at stable prices. So here we are, 3 days before the rules change permanently. Shanghai trading at a premium that keeps widening. COMEX vaults draining at unprecedented speed. 542 million ounces of paper, claims backed by 97 million ounces of physical metal. Industrial users scrambling for supply. Lease rates spiking. Backwardation signaling severe shortage. And most Americans completely unaware that the silver market is experiencing a fundamental structural break. The people who saw this coming months ago took action. They converted paper to physical. They secured allocated storage. They positioned for the supply deficit everyone can now see approaching. The people who ignored the warning signs because COMEX prices looked stable and financial media was not sounding alarms, they're about to learn an expensive lesson about the difference between paper markets and physical reality. Remember that impossible price gap we started with? $72 in New York, $78 in Shanghai for the same metal at the same moment. That gap exists because one market trades paper promises while the other trades physical metal. And in 72 hours, the physical market becomes the only market that matters. The question isn't whether silver prices are going higher. The question is whether paper markets can survive the transition to physical scarcity, or whether they collapse into irrelevance while real price discovery moves to Shanghai and the physical spot market. This is how systemic change happens. Not with dramatic announcements or market crashes, but with quiet structural shifts that most people miss until it's too late to position themselves advantageously. The silver market on January 1st, 2026 will be fundamentally different from the silver market of December 31st, 2025. Different supply structure, different price discovery mechanism, different risks for paper claims, different reality for industrial users. We've been warned by the data, warned by the physical premiums, warned by the vault drains, warned by backwardation, warned by lease rate spikes, warned by industrial users like Elon Musk, who actually depend on silver supply for their businesses. The warnings are all there for anyone willing to look past the paper price and examine what's happening in the physical market. In 3 days, we see whether those warnings were accurate or whether the system finds some way to continue functioning as it always has. But given the evidence we've examined, the October export flood, the Shanghai inventory collapse, the COMEX vault drain, the leverage ratio, the supply deficit math, the smart money isn't betting on business as usual.